Hey everybody, welcome to yet another episode of the yet to be named podcast. Matt Bouts, certified financial planner, and Alan Nays, CPA, here putting our heads together for business owners, uh, trying to be collaborative on the best and talking about the best tax strategies, financial planning strategies, holistic business planning strategies. I would say, Alan,
Yeah.
it's good to be with you here again.
Yeah. Same. Good to be with you, Matt.
Yeah. We got a good topic today. It's another tax-focused topic.
Right.
Um, it's everyone has heard of, or I shouldn't say everyone. Many people have heard of S corporations and the strategy around S corporations. And we're going to be diving into it in detail today, Alan. We're going to be jumping into it. We're going to be picking your brain on all the tax implications, and I think understanding what it is, why it's a strategy in the first place, and who it's an optimal strategy for, and just kind of getting into the weeds on that.
Absolutely. It is the biggest filing business entity. It surpassed all other business entities several years ago. So
Oh, really?
it makes
There you go.
sense.
I didn't even
Yeah.
know that.
Yeah. It makes sense why there's a lot of discussion about it and why small business owners should be focused on whether it's a right fit for them.
Yeah, as someone who is an S corp, I can attest that this is a wonderful strategy. Um, so let's dive into it. Let's dive right into it. Let's start with this, Alan. Why don't you just give us a brief overview of what an S corporation is relative to, a Schedule C or just your standard sole proprietorship business, which is the easiest one to start. Just give us an
Yeah.
overview. What is an S corporation? What does that mean?
Well, an S corporation is a pass through. So, but let's take a step back. And one of the first things that small business owners do, and whether they got advice from an attorney or they heard about it on TikTok or wherever they heard it, they form an LLC and they think, all right, I'm a business, I got an LLC. But the one of the problems with an LLC is just a single member LLC's default tax position is a disregarded entity. So you're filing a Schedule C. It's the same schedule, the same tax form that a sole proprietor files. So effectively, you formed an LLC, but from a tax perspective, you haven't done anything. It's in the IRS's eyes, you're in the same position.
Yeah.
So
And so the only thing you're doing if all you're doing is setting up an LLC, which generally speaking, LLCs are great,
yeah,
but they're for legal and liability purposes, right?
it's an asset protection strategy.
Right.
It's not a tax strategy. At least you have to. It's not a complete tax strategy. We'll put it that way.
Right. Right. And I see this often, and there's confusion around it, what an S election is, and all these different things. We can dive into that.
Yeah,
But that's an important thing to note is that when you set up an LLC, if you don't do anything else, it's just taxed the same way you would be if it was just, Matt Bouts and Company, right?
yeah, and that might not, that might not have any relative basis for anyone. So one of the problems with being a Schedule C, filing Schedule C on your personal tax return, is that income is subject to what they call FICA tax or self-employment tax, and that's a sticker shock for a lot of new business owners or even established business owners that maybe they bought equipment initially and they didn't have a tax liability, and all of a sudden now they do. They made money this year. Now they got a tax liability. Self-employment tax is 15.3% on top of your regular tax rate.
Right. And
So
I've got to opine on this because when I was a young man starting my business, like many people that start a business, you don't make any money the first few years. You lose money,
right,
right? You don't
yeah,
have to worry about taxes, right?
right,
I remember the first year I actually had some success, and boy, this came up and bit me right in the what, and it was a problem cash flow wise
yeah,
because it is 15.3% on top of income taxes, and I just
right.
wasn't planning well for it. So yeah, it can sneak up and bite you if you're not paying attention.
Yeah, you can get really close to 50% tax rate when you factor in, depending on what state you're in. So it,
Yeah,
it can be really punitive. And not to mention,
Minnesota.
Yeah,
It gets pretty darn close. It gets pretty darn
right.
close up here. Yeah.
Minnesota's bad. We've learned that.
Right.
No, I
Right.
shouldn't say bad. Their tax rate's high.
I mean, you can say bad. You can say bad. I would say bad. But
Right.
I guess you're right. It depends on your perspective, right?
Yeah, I guess so. If you're writing a big check, maybe you agree with me. So,
Right. Right.
but it's punitive. Well, that big check is punitive because what a lot of small business owners do is they're constantly reinvesting in their business. They're growing. They've got to buy more equipment. If you're a trade, maybe you're buying trucks and vans. You're making other investments. You want to hire people in your office, and that every tax dollar that you pay is a dollar that you don't get to invest in your business, and that's really where it becomes really punitive. And if it's a matter of filing the right forms and getting yourself set up correctly, you really got to pay attention to these things.
Yeah, and just to expand on that, so if you think about that conceptually, if I own a business and let's say I make 100 grand a year, but I'm really only my piece of that my family lives off of, and these are small numbers, right? Let's say it's 50 grand to keep the math simple. That
Right.
other 50,000, it shouldn't be paying payroll taxes or these FICA taxes because it's not really income. Because I'm investing that into my business, right? Down the
Right.
road. And maybe this was a good lead into the S Corp. It essentially allows you to do that. And dare I say, skip the 15.3% tax.
Right. It is what is commonly referred to as a pass-through entity. So it files a tax return, but it doesn't pay its own tax. It passes that income via the K-1 down to the taxpayer, and the taxpayer ultimately pays that tax. But the beauty or the magic of an S corp is when it passes that income down to the taxpayer, is it passes it free of self-employment tax, free of FICA taxes. So that 15.3%, as a matter of filing paperwork, is now gone.
Right. So, and that's the beautiful thing about this is it really depends on what your business goals are, right? If you're investing all that money into your business, then right, you could just effectively eliminate that tax, I would imagine, right?
Yeah, it certainly does. Yeah.
Yeah. But there's, I think that there's nuance too, because not all of us are investing 100% of what we're getting back into the business, right? Some of us need some money to live off of. Boy, I'd love to get to a point where I don't have to do that and I'm just living off of capital gains. But that's a podcast for down the road, right?
Passive income.
Right.
Yeah.
Just completely financially independent. So talk to me a little bit about how you might set this up for someone who needs to have some sort of a salary, obviously, right? Or to live off some money. And how can you structure that in a way where you're eliminating a lot or much more of those payroll taxes so you can have that money extra to invest back in your business or otherwise?
Yeah. Well, to talk about that, we have to talk about a couple of requirements of the S corp. So it's no free lunch here. The IRS is very in tune, and they highly scrutinize this requirement as well. So it's something to really pay attention to. You have to pay yourself what the IRS calls a reasonable salary, and it's not a mathematical equation. There's no magic number. How reasonable salary is defined is what would you pay a third party to do the job you're doing. And if you're like a lot of small business owners, you wear very, very many hats in your company. Mm-hmm. So that's where the rub is with it. It's like, well, what really is a reasonable compensation that you're required to pay? So let's talk about how that works. So you have your total profit of an S corp, right? Let's say it's $100,000 to continue your example. Let's say your reasonable compensation is $50,000. The other $50,000 flows down to you free of the employment taxes, because you do have to pay employment taxes on your wages, just like you would in any other job. It's a regular W-2 salary. It's that $50,000 of profit that you're shielding from that self-employment tax. That's how you're saving money.
Yeah. Yep. And that's the simple way to do it is you essentially set your salary. And to your point, you wear lots of different hats, right?
Right.
If you're an HVAC business that handles that stuff, for you to replace what you do for your business just with the professional HVAC stuff, not the business stuff. And this
Right.
is what Alan's talking about. When you own an HVAC company, there's a lot of other pieces of that business to run it effectively than just understanding how to repair or install HVAC systems, right?
Sure.
For you to hire that position out and pay someone to do that is less than what the profitability of the business is. And this is an exercise a good team of experts can help you come up with, because frankly, the language is pretty vague by the IRS. There's no like cut and dry, like it's reasonable compensation. Well, what does that mean? And what we have to do is look at tax law to kind of come up with what they've said, right? And there's a process, and I know Alan has got a great one for determining that. And a good professional CPA should be able to help guide you through that process. But there is nuance to it, and you can't just you can have $100,000 of profitability and just put $5,000 in there, right? If you're doing work for the company, right?
Sure.
So
that's not reasonable. I mean, you wouldn't be able to replace your
right?
salary.
But what is reasonable, right? It's pretty subjective, right?
Well, you have to be pretty organized to get to what is reasonable, and you have to have a system to get there. It's not difficult to do, but you have to have a system to get there. So you look at what a small business owner does. Like, okay, well, they might do bookkeeping, accounting. They might spend time running to the bank, doing payroll, admin work. There's so many different things, and you might not even realize all the hats you're wearing in your company until you start to kind of break it down like this. But and then on top of that, you have to deliver services to your clients too. So you start putting your time into buckets, and okay, well, a bookkeeper makes this, and a janitor makes this, and HVAC professional, for example, makes this, and then you start to come up with a more formulaic approach to it. And the way we do it has been audit tested, and it's never failed. It's always passed reasonable compensation scrutiny from the IRS.
Right. And and the takeaway to this is, I love how the way that you put that is it's not complex, it's not hard. You just have to have a process. And you have to know what the IRS is looking for in that process to ensure that, again, if it ever comes up, you can just show them, nope, here's how I came up with it. Sure. And it's very reasonable, right? Yeah. And you just have to have the process behind that in place, and then you're kosher. And to Alan's earlier point, this is the most common entity now. So this is not rocket science. You just got to get it done.
Yeah. The IRS has really ramped up enforcement in the reasonable comp issue. And, I feel like it is an area that is commonly missed when when clients come to me from another tax preparer. I'm like, well, we need to take a look at your reasonable comp. You don't want to be too high, because you're just going to, lose the savings of the S Corp. You're going to lose it to those FICA taxes on your W-2 salary. And you don't want to be too low either, because if in the event you did get audited, you're going to have to pay all those FICA taxes, and then you're going to have to pay an accuracy related penalty, and then you're going to have to pay interest on top of that. So, you got to find that sweet spot, do a risk assessment there and find
and I want to add the nuance from my perspective of things, where I've collaborated with lots of different accounting and tax professionals over the years. And Alan, to your point of saying, hey, I see people's stuff and how they're set up, and sometimes they're too high, sometimes they're too low. Yeah, I would say most often than not, because this is the nature of most tax professionals, is to be exceptionally conservative.
Right.
And I've seen situations where tax professionals say, no, it should be around the $140,000, $150,000 range. Even if you make $160,000, you shouldn't go below that, because it could trigger an audit. They want to use all of the FICA wages, right, Alan?
Yeah,
And I've seen
it's
that
not going to
before, and
trigger an
that is
audit, by the way, either. It's not going to
say it
trigger an
again.
audit. It's not going to trigger an audit. There, nothing about your owner's wage. If there's no wages, it could potentially trigger an audit. But
Right. And I just want to say this as another professional who's not in the tax seat, but I see this because the people that work with us we're asking for all this information so we can see it, even though we're
right,
not the one executing it, their current CPA or tax accountant is. It's
yeah,
constantly, a lot of times tax professionals are too conservative with this. And you don't
yeah,
want to be too aggressive either,
right,
but you want to take advantage of what the tax code allows you to take advantage of. And sometimes that's just a matter of ignorance or just not understanding fully what's really available
well,
to someone.
you're exactly right, Matt. The CPAs, a lot of CPAs, a lot of tax returns I've seen prepared by other people, they are too conservative. You're 100% right. Um, but we are here to inform our clients of the rules, right?
Right.
We're supposed to be, hey, supposed to help our clients through these complex rules.
Mm-hmm.
But assigning a salary too high is not following the rules.
Mm-hmm.
Because what the IRS says, it has to be reasonable compensation for the job that the business owner is doing. It's not, it has to be, what I've seen a lot of CPAs do is, well, it has to be 75% of the income. No, that's not the rule. So you're being conservative for no point. You're also not following the rule, and by not following the rules, you're putting your client at a disadvantage as well.
Yeah. And I think, you tell me if I'm wrong, if you're more inclined, if you're a business that's growing rapidly and investing in yourself,
Yeah.
you're probably going to be able to be more aggressive with that salary than someone who's not, right?
Yeah. Yeah.
And these are the kind of things where your professional team of people should be asking those kind of questions. What are your aspirations? What are you trying to accomplish long-term, medium-term, short-term? Because that can affect the tax planning from day one, right?
Right.
Anyway, this is the S corp, and that's the nuts and bolts of it. Is you can save on payroll taxes. What would you call them? You call them FICA taxes, Alan. There's lots of different terminologies for it.
Yeah, it's the FICA taxes is one way to put it. It's self-employment taxes as it shows up on the tax return, but it's your Medicare, it's your Social Security.
Yeah, Medicare and Social Security.
Yeah.
And again, these are all within the tax rules. It's Talon's point. It's about explaining the rules, understanding the rules, and taking advantage of the tax code as it is written.
Sure.
And it's like any game. I tell my son, who's 8 years old, I coach baseball, which, by the way, we got first place in the 8-year-old local town team tournament. And I'm not going to say it was all the coaching, but it was the coaching.
It was the coach.
No, but seriously, not to toot my own horn, but seriously, you know what's the difference between 8-year-old baseball teams? Knowing the rules. They knew what a double play is. They knew what tagging up meant. And guess what? When you're 8 years old, that is the difference.
Wow.
And not dissimilar to this, you got to understand the rules exceptionally well when it's something as complicated as the tax code. Is there anything more complicated than the tax code? If you know the rules, you know the rules that you got to play by, it allows you to take advantage of them, right? And you play better.
I've been doing it for 20 years and I'm still learning. So,
right.
And they change them.
So my dad, all right, here's a little personal story. My dad worked for the federal government, the Department of Interior, Bureau of Land Management, for his entire career. 20 years old, he got an internship up until retirement.
Yeah.
And he likes to joke and say, if they went back and started at the very beginning to try to make the American tax code as complicated as possible, they could not make it as complicated as it is right now. Yeah. And I think I love that quote because it comes from somebody who's been in the federal government for 40 years and he kind of knows the how it operates. Sure. And I think as business owners, we can all have a chuckle at that because it is what it is. But in some ways, it's a very true statement.
Very true. It's hard for a small business to operate these days.
Yeah, it's impossible. If you're an expert in your field, and for you to be expected to understand this stuff at any sort of a deep level, it's impossible. Right. And just to put that out there, y'all, I am a certified financial planner. I know a lot about taxes, yet I pay for my companies. I pay tax professionals a lot of money to advise me on the best things to do. And so
Sure.
put that into perspective. And all of that, by the way, I wouldn't be paying that money if it didn't make sense to do it, right? I'm getting a return
Yeah.
on the good advice that they're giving. So anyway, um, anyway, we're going off on a tangent there, Alan. S corporations, it's a great strategy.
One more point about reasonable comp.
Yeah,
You know, a lot of people initially think that, okay, well, my salary is what the cash flow I get from the company, and that's not true either.
right.
You can take a distribution from your S corp. If there's profits, you can take a distribution and supplement your W-2 salary to whatever personal cash flow level you need.
Yes, that's a great point. Just to conceptualize this for everybody, I'll just say it in a different way. If your business is $100,000 profitable and you're not an S corp, right? That's $100,000 you're getting, right? Less taxes, of course. You set up an S corp. Let's say you set your salary at 50,000. Just an example. That doesn't mean the other 50,000 isn't available for whatever you need it for, whether it's spending or investing in the business. It's not like you have to invest that into the business. It's still available as cash flow for you, just without that 15.3% tax, right? And you listeners can do the math. 15.3% on $50,000 is not a trifle sum of money, right?
Sure.
But yeah, that's a really good point. It doesn't mess with your cash flow at all. It improves your cash flow, frankly,
It improves
when executed properly. Yep.
Yeah.
Good. Anything else on S corps, Alan? What are we missing?
Well, I think we should talk about when to be an S corp, because
yes, when to be an S corp. This is a good one because we all get into business because we're passionate about something, and then all of a sudden we become profitable, and taxes then become a problem. At what point? And I always tell people this: don't worry about the structure of your business. Get started, be successful first, and then we can figure some of this stuff out. Sure. At what point, you're doing a Schedule C, you're hammering it through, and all of a sudden taxes are a problem, right? Because you're paying them. At what point does it make sense to start at least considering this as an option in this corporation?
Well, I mean, an argument you might hear is, well, why not do it right away? And here's why you don't want to. To be an S corp, you have to file an S corp tax return. You have to maintain a set of corporate books, and they have to be fairly tidy. And you also have to run payroll. All of those three things that I can think of off the top of my head, and I'm sure there's others, but those three things are all admin costs, and they can nickel and dime you. And if you save $5,000 in taxes and you paid your accountant $5,000, okay, maybe you'd rather put $5,000 in your accountant's pocket. I appreciate that, but than the IRS. But as a business owner, you're just treading water. So the savings of the S corp has to grossly outweigh the admin cost and all the pain in the butt to manage it, right? So typically, what I see is that tipping point is somewhere around $100,000 a year in profit.
Mm-hmm. Yeah.
Now, maybe you're pretty savvy with this stuff, and you just want to be ahead of the game. You just want to do it. That's great. But where I see it having the ROI or the cost benefit really starting to tip in the favor of the small business owners right around $100,000. Now, and I also say this, like, you don't want to do it prematurely either, because if you are going to run unprofitably, and you are, because you have depreciation, you're buying equipment, and you're kind of startup mode for the first couple of years, why go through the effort of running payroll, filing a tax return, maintaining books? Why do that if you're just going to have a loss on your tax return? At that point, Schedule C doesn't hurt you. So it's a little easier. It's the path of least resistance. So $100,000 a year in profit. That's what I say.
Right. Yep. And that's why I say what I say. I get sometimes young people, hey, what should I do to start my business? Just get started. Go provide value to the marketplace and collect a check for that value, and be profitable first. So anybody listening to this that is up and starting, or they're maybe switching from being an employee and in some sort of contractor role, to owning their own business or being a contractor. Make sure you're profitable, and then dive into this. Right? There's things you can do, but you gotta have money coming in the door. If you're focused on this stuff before you have that, you kind of got the cart in front of the horse.
Right.
So I think that's great. $100,000 in profitability, and then once you get above that, then it becomes a way. How can you keep growing the business and not getting destroyed by Mr. Taxman? Right.
Right.
It is. It's the biggest expense we have. The biggest clients that I talk to, the conversation is, it's not about, hey, Matt, how are my investment returns? It's okay. Those are my investment returns. Great. How is that affecting my tax bill? How is that affecting my tax bill? Right.
Yeah.
And it's taxes. It's taxes. And it's if you can reduce your taxes, it's the best way to increase your returns. If you're looking at everything holistically, if you're talking about an investment, it's not what the investment is doing. It's what is the investment, what it's done after your tax bill, right? It's what do you get to keep? And when you start looking at your world and from that perspective, you start making different decisions. And it's the best way to increase the return, managing the taxes. Yep.
Right. Yeah, absolutely.
And S corporations, it's the best. It's a common strategy, and I would say it's less commonly executed well. Right.
Correct. The devil is in the details.
The devil is in the details. That's one of Alan's things. His sayings. I like that. The devil is in the details. Absolutely. Yeah. Good. All right. Well, that'll wrap us here for this episode. Yeah, that's all I got, Alan.
Yeah, we'll have to put our heads together, come up with a topic for our next episode. So we don't have anything to announce here, but we promise a real barn burner for the next one.
Yeah, a real barn burner. And by the way, if anybody's listening, feel free to ping us with topics that you'd love to know more about. We'd love to hear any sort of feedback that way. But yeah, we really are, sincerely trying to bring good stuff to the community and provide value here. So we're all ears for feedback. Look forward to talking to you guys all next time, Alan. Until next time.
Yep. Thanks, Matt.